It's Brian Preston, the money guy.
We all hear the adage, buy low, sell high.
Yep.
But nobody really does a good job of explaining what does buy low look like. It's gotta hurt.
Mm-hmm.
I mean, it's gotta hurt. So that's why I want you to have boundaries to understand what cash, what safe assets should look like, because the contrarian, the financial mutant opportunity is now let's talk about risk assets and the good with volatility. The good with bad news is that pessimistic situations create tremendous opportunities for anybody who's got that optimistic long-term outlook.
That's exactly right. If you're someone in the accumulation phase, if you're someone building, or perhaps maybe you're even in retirement, but you're looking at your allocation, you're looking at the way your portfolio is structured, and you recognize maybe it's not been where it needed to be. Maybe I did allow myself to get too conservative. Maybe I did allow myself to be too scared of the markets. Recognize right now there's a huge opportunity that things are on sale. The market is on sale. And even though it feels uncomfortable, even though it is scary, if you can be that contrarian that learns how to be fearful when others are greedy, and right now greedy while others are fearful, you can capitalize on this. And you've seen this illustration 1,000 times before if you've been watching us for any period of time. But we all know about the Great Depression. It was this 25-year period where the market essentially closed at this point, and then 25 years later it closed, and it had not moved at all. It was this giant crater in the market. Well, if you would have just bought on the day before the Great Depression started, and then you would have just held it for 25 years, yeah, your portfolio is not looking incredibly great. However, if you could figure out how to power through that volatility, and you could have invested consistently, in this illustration we use, we say $10,000 invested each year, starting in 29, going all the way through 54, even in a period where the market seemingly did not make money, you could have annualized almost a 12% rate of return because of the opportunity that volatility provided you.
I can't remember if it was on Twitter or if it was on our YouTube comments, but I was like, this person's got to be clowning me, because they said, well, problem with the way you guys do your content is you always assume the economy's growing. Mm-hmm. What if we hit that period from 1929 to 1954 where the market's made nothing? Mm-hmm. And I was like, he's clowning me. He doesn't
Surely,
know.
Has he not seen this
He's
episode?
either part of the 40% that's discovering us every month, or this is a financial mutant trying to give me the biggest softball opportunity to kind of lay it out there, because they're exactly right. And in 1929, in September 3rd, the Dow Jones was at 381. And then you fast forward to I mean, if you think about that, that is 25 years in the future. Fast forward to November 23rd of 1954. That's almost a full generation ahead. It's 383. Mm-hmm. Again, that's less than $2 difference between there. So you hear that and you're like, oh my goodness, the economy just wasn't growing. But as Bo just shared with you, if you just dollar cost average through that volatility, you would have averaged 11.7% per year. So volatility is your friend if you think about this. And by the way, I also want to put an exclamation on this opportunity, because we're about to show how fast things recover. But I do want to remind everybody, we buy into the law of accelerating returns and the fact that if you look at how good things are growing, the innovation, the way technology is changing, it's not slowing down. Mm-hmm. It's actually accelerating. If you think about what happened from when I was born in the 70s to what we're now doing in 2022, take it to the difference of when Bo was born in the 80s and what has happened now. More stuff has happened now. I mean, it is accelerating to where in the next 10 years could look like the first 25 years of it makes it look like it's standing still. Yep. That is going to be something we're going to be able to profit off of. It's going to be something that globally will expand the economy. Nobody has to lose for opportunity of a growing expansion of innovation. It's human nature. You need to be on that ride because, look, and this is a great time to hear this information, absorb it, and see how you can maximize this potential for you, because we shared earlier, the market is down 25% right now. But I want people to understand markets recover quick. Mm-hmm. And here's the thing I need. You see that most bear markets, I told you, 2 out of every 10 years, you're going to have down years. You usually have a bear market as part of that. And I want people to know, when you have bear markets, they do average around 35%. You're like, wait a minute, guys, you just showed me we're down 25. That means it could get worse. Yes,
It could.
It could get
Very
worse.
well could.
But here's what I need you to understand on when it gets worse. It could get worse all of a sudden, meaning that we have dragged along here for 10 months now, and we've expanded this. We've had some fits and starts of things recovering. But when it does get to the bottom, we might be at 25, and we all of a sudden, the market could next week, 2 weeks, 3 weeks, it could all of a sudden lose another 15%.
Sure.
But here's what I do know. When we hit that dead bottom, 1 month later, the recovery's on average close to 15%.
Yep.
3 months later, it's 21%. Fast forward 12 months, close to 44%. 24 months, we're close to 63% recovery. So what I'm telling you is, this is not a bad time, even if we have another 10 to 15% to give back, because when you start always be buying, if you're dollar cost averaging, just like we showed on the previous slide, if you're buying low consistently right now, when that thing whipsaws with the V-shaped recovery, you're going to be so happy that you will always be buying and not letting yourself get distracted with the negativity of the press, with how your portfolio looks on a monthly basis right now. All that's going to seem like distant bad memories because you will have bought low. So you have the potential down the road when you need the money to sell high. That's incredible.
Here's what I think is so scary about this, though. If you start trying to get cute, and if you miss it, look at this. In the first month, on average, it makes back 15%. But if you look at the first 3 months, it makes back 21%. 2/3 of that first 3 months return happened in the first month. So if you miss it, you're out of luck. Think about this. In the first year after the recovery, market on average makes 43.5%. It made half of that, 50% of that return in the first 3 months. So you have to be there when it turns, or you miss out on the good stuff. You miss out on the rapid recovery. So there's a reason that Warren says, learn how to be greedy when others are fearful, not learn how to be kind of greedy when everybody's like not super worried about things. That's not the way that it works. That's why when you design a portfolio, when you design a strategy, you want one that's really good before the stuff hits the fan, that stays really good while the stuff is hitting the fan, so that it will continue to be good after the stuff has gotten out of the fan.
Well, and I think it's also, we're in this time now that interest rates are going up. In addition, it gives this false soothsaying opportunity. You used to be like, hey, at least I'll just wait for the dust to settle. I'll stay in cash because at least cash is making me, I can't lose money in cash. I'm getting 3 to 4% on my cash, with what the Federal Reserve is doing. But here's the reality of the situation. Remember, purchasing power at the end of the day is what you're worried about.
Right.
What will your dollars do in retirement for you? And I know that, yes, equity returns can be volatile. But if you have a nice diversified approach and you know that you have at least half of your assets working in growth risk opportunities like equities, that since 1980, the S&P 500, which is a great kind of, if you want to look at a benchmark or a way or proxy to figure out how you look at equity investing, and you can see since 1980, annualized 8.98, not return. That's 8.98 after inflation. Guys, that's protecting purchasing power. So hang in there on this volatility. You're going to be okay. You just got to stay the course, have the strength to know why you're doing what you're doing with your money so that it can actually have the maximum opportunity to be fulfilled and really turn into the best version of yourself financially.
Yeah, I want to say it a little bit differently because we hear since 1980 and SP's done it. I want you to think about this. Since the last time, before this last year, the Georgia Bulldogs won the national championship, since the savings and loan crisis, since the dot-com bubble burst, since 9/11, since the Great Recession, since COVID, since fill in the blank on the thing that's happened over the last 42 years. And the market has been incredibly resilient as a method and mechanism to protect your purchasing power over the long term. Could this market get worse? Sure. Could there be other scary things that happen? Sure. Have we seen these types of things before? Yes. Has the market proven over time that it rewards those investors that can stay level-headed and disciplined over the long term? Absolutely.